Imagine it's 1st December 2001. You're a 34-year-old accountant living in Buenos Aires, Argentina. You live in a small apartment with thin walls, a metal fan that clicks all night, and a kitchen drawer where a few US dollars sit folded inside an old envelope. Each morning you ride the subte to work, check invoices, balance numbers, and tell yourself that 1 peso still means $1 because that is what the country has promised for years. Your salary arrives in a bank account, your rent is due in pesos, and your parents still believe the banking system may bend but will not break. On weekends, you buy canned food, help your sister compare prices, and listen to neighbors argue about rumors of default, as if collapse were just bad weather somewhere far away. You do not feel rich, but you feel orderly, and that feeling matters because order is what money is supposed to buy. If you have ever wondered why some wealth vanishes when a currency fails, while other wealth seems to step through the fire untouched, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened in Berlin, Harare, Nicosia, Beirut, and Buenos Aires. And if this kind of historical clarity helps you see the world with sharper eyes, subscribing takes 2 seconds and keeps you ahead of what most people never see until it is standing in their kitchen. Then the television flashes with a late-night announcement from Economy Minister Domingo Cavallo. Cash withdrawals from bank accounts will be limited to $250 or pesos a week. The measure is sold as a temporary shield, but everyone understands what it really is. The door has not been locked yet, but the key is already turning. Within weeks, Argentina will be in chaos, protests will fill the streets, more than 24 people will die, the country will default, and dollar deposits will be forcibly turned into pesos. For millions of people, the number in the bank was revealed to be not money, but a promise, and promises can be rewritten. That is what this video is about. Not panic, not prediction, pattern. When money breaks, when the unit people trust begins to melt, which assets actually survive? And why? History gives a hard answer. The winners are usually not the people with the biggest numbers on a screen. They are the people holding claims the system cannot easily print, freeze, or redefine. The losers are often people who did everything they were told to do. They saved in the bank. They trusted the salary. They believed the pension statement. They thought cash in a local account and wealth were the same thing. They are not the same thing. And once you see the difference, a lot of history begins to make terrible sense. Before we go further, there's something important to understand. Money is not wealth. Money is a measuring tool, like the markings on a ruler. If the ruler starts stretching every hour, the table in your house has not changed. Only the tool you use to measure it has. The deeper problem is that modern money is also a promise. A bank balance is a promise. A bond is a promise. A pension is a promise. A wage contract is a promise. These are what economists call nominal claims, which simply means claims written in money terms, like numbers on paper or on a screen. They look solid because the numbers are exact, but when the money itself cracks, those exact numbers become like addresses written on ice. This is the secret key that unlocks the whole story. The assets that survive are usually the assets closest to reality and furthest from political editing. A gold coin is not a promise from a bank manager. A plot of productive land is not a promise from a finance ministry. A stock in a business that sells food, fuel, or exports is not just a number. It is a slice of something real. Foreign currency held outside a failing system is not perfect, but it is at least anchored to a different ship. By contrast, a local savings account, a long bond, or a fixed pension is like building a house on painted scenery. It can look sturdy right up until you lean on it. When money breaks, 3 things usually happen at once. First, the state or the banking system tries to trap value inside the system. That is where you get capital controls, rules that stop people from withdrawing, moving, or converting their own money. Second, prices race ahead of wages and savings. That is where purchasing power dies, which is a technical phrase for how much your money can actually buy. Third, value runs for the exits. It flows into hard currency, hard assets, useful goods, export businesses, land, inventory gold, or even plain old canned food. Collapse is not usually a bomb. It is a migration. Value leaves the promises and hides in the things that do not need permission to exist. Now, here's where it gets interesting. The first great lesson comes from Germany in 1923, the most famous money breakdown of the modern age and still one of the clearest. Hyperinflation, which means prices rising so fast that money loses value faster than people can spend it, did not arrive as one dramatic day. It built like rot under floorboards. Germany had left the gold standard during the First World War. It carried huge debts. It faced reparation payments after the war. Then, in 1923, after Germany fell behind on payments, French and Belgian troops occupied the Ruhr, the industrial heart of the country. Berlin answered by supporting passive resistance. Workers were paid for not working. Production fell. Printing rose. The state tried to pay real obligations with unreal money. That is like trying to patch a sinking boat with painted cardboard. The numbers are still hard to believe. According to Britannica, the mark fell to 160,000 per US dollar on 1 July 1923, then to 242 million per dollar on 1 October, then to 4.2 trillion per dollar on 20 November. The BBC notes that a loaf of bread that cost 250 marks in January cost 200 billion marks by November. Victor Klemperer, the 42-year-old professor in Dresden whose diaries captured the madness, described a cafe where the price board showed 6,000 marks, then 12,000 marks before the customer finished drinking. In another snapshot of the period, a family of 5 reportedly needed 10 million marks to survive by 1st August. Money was no longer a store of value. It was a hot coal. You held it only long enough to throw it at something else. What did ordinary people live through? They were paid and ran to the shops. Wages arrived in wheelbarrows, suitcases, and bundles. Pensioners and clerks watched decades of saving turn to wallpaper. Middle class families sold heirlooms for food. Meat became rare. Coffee became a luxury. Bread became a moving target. The rhythm of normal life broke. Money is supposed to be a clock. It tells a society when to save, when to spend, when to lend, when to plan. In Weimar Germany, the clock started spinning like a fan blade. But here's the part many people miss. Even in disaster, not all balance sheets die the same way. Recent NBER research on the German hyperinflation shows that unexpected inflation shifted wealth from creditors to debtors. In plain English, the people who were owed money lost. The people who owed money often gained. Firms loaded with nominal debt saw the real burden of that debt collapse. Their old loans were repaid in melted currency. Some highly leveraged industrial firms actually increased employment and production because inflation crushed their debt overhang, their pile of old debt that had been weighing them down like wet concrete. Germany, one observer said, became paradise for anyone who owed money. That is a deeply uncomfortable fact. Savers were burned. Debtors were lifted. And this brings us directly to the asset question. What survived better than paper marks? Hard foreign currency, gold, productive land, shares in real businesses, though not all shares equally. Claims tied to real output or foreign earnings did far better than cash balances and fixed income claims inside the local currency system. The new Rentenmark, introduced on 20 November 1923, was backed by mortgages on Germany's agricultural and industrial resources. That detail matters. Stability returned only when money was tied back to something the printing press could not casually invent. The lesson was brutal but simple. When the measuring stick burns, what survives is the thing being measured, not the ash of the stick. Here is something I want you to think about before we go further. If your bank balance can be frozen, converted, haircut, or inflated away, is it really an asset, or is it only a claim on an asset so long as the system remains polite? Drop your answer in the comments, seriously. Because what comes next is the part of the story most people never hear. It is not about wheelbarrows of cash. It is about spreadsheets, bank apps, and middle-class families who thought the 21st century had made this kind of thing impossible. Argentina in 2001 and 2002 looked very different from Weimar Germany on the surface. Buenos Aires had high-rises, ATMs, debit cards, and a currency board that had tied the peso to the dollar for years. 1 peso, $1. Clean, simple, modern. That promise became the country's glass bridge. It looked solid until too many people stepped on it at once. Argentina was carrying a mountain of debt. Growth had stalled, confidence drained away. Depositors began pulling money from banks. On 1st December 2001, the government imposed the Corralito, limiting cash withdrawals to 250 pesos or dollars per week for 90 days. Salaries and pensions up to 1,000 could still be withdrawn each month. The card still worked, but the message was clear. Your money was still yours right up until you wanted it. The emotional shock was instant. Savings are not just numbers. They are stored time. Years of commuting, working, skipping vacations, saying no to small pleasures. When those savings are trapped, people do not feel poor. They feel robbed by the past. Reuters later described how desperate Argentines fought to rescue their savings as banks were boarded up and the streets of Buenos Aires turned into battlegrounds. President Fernando de la Rua fled the presidential palace by helicopter. More than 24 people were killed in the unrest, not because the banking system vanished in a puff of smoke, because trust did. Then came the second blow. After the default, dollar deposits in commercial bank accounts were seized and exchanged into pesos. The thing people thought was safe, because it was in dollars, turned out not to be safe because it was inside the wrong legal box. This is one of the most important patterns in the entire history of money breaking. The currency matters. But the wrapper matters too. A dollar bill in your hand is one thing. A dollar promise inside a trapped banking system is another. Same label, different reality. Now look at what happened next. Reuters profiled accountant Carlos Pinheiro years later. He said he had been lucky in 2001 because he distrusted banks. He kept dollars elsewhere, held onto his savings, and was later able to buy an apartment because property prices in dollar terms fell sharply after the crash. Think about how strange that is. In a national collapse, a hidden envelope of cash can outrank a respectable bank account. A person who looked paranoid on Monday looks prudent on Friday. The safe became risky. The improvised became rational. When money breaks, history often rewards the person who refused to confuse convenience with security. That does not mean every hard asset wins equally. Argentine property owners who needed to sell in distress often suffered badly. Reuters quoted a toy factory owner, Norberto Garcia, who said he had to sell real estate at knockdown prices just to survive after the 2001-2002 crash. The tide did not lift every boat. It lifted the boats that could float long enough. That matters. A real asset under forced sale can behave like a paper asset. Timing becomes a knife. If you are liquid enough to wait, the apartment may save you. If you must sell at the bottom, the apartment bleeds with everything else. So what actually survived in Argentina? Not trust, not local bank deposits. What survived best were assets outside the freeze, outside the forced conversion, or tied to real goods and export earnings. US dollars held outside the banking trap. Inventory. Productive businesses that could reprice. Some land. Some property bought after the collapse rather than before it. Again, the pattern appears. The closer an asset was to political discretion, the weaker it proved. The closer it was to something real, scarce, or external, the better its odds. This leads to the second part of the story. And this one is even more unsettling because it took place in a country where the currency did not just crack. It died in public. Zimbabwe in 2008 was not merely inflationary. It was monetary disintegration. A slow national fever turned into a blaze. The roots ran through land seizures, a collapse in agricultural output, war spending, sanctions, shrinking exports, and a government that kept filling fiscal holes with new money. By the late 2000s, the Zimbabwe dollar was less a currency than a rumor. The figures are staggering. Reuters reported annual inflation at 231 million% in July 2008, adding that economists said prices were doubling daily. The BBC later summarized the peak more starkly. In November 2008, prices were rising at 79 billion% a month, a daily inflation rate of 98%, doubling every 25 hours. Imagine ice melting in your hand. Now imagine your paycheck doing it faster than that. Shops repriced several times a day. Water and power cuts became common. Bank queues stretched. Supermarket shelves thinned. People crossed into South Africa and Botswana to buy basic goods. The dollar, the rand, and anything else with a pulse began to replace the local unit. And this is where history gets uncomfortable. In Zimbabwe, one of the clearest signals of reality did not come from the state at all. It came from a stock. Economists later used the price gap between old mutual shares in Harare and London to estimate the implied exchange rate, because the official numbers were so broken they could no longer describe the world. That is a stunning fact. When money collapses, markets begin whispering the truth through side doors. A stock listing becomes an exchange rate machine. A black market becomes a national accounting system. Reality leaks out wherever it can. What did ordinary people live through? Reuters described an economy where more than 83% of the population was living on less than $2 a day by 2005, and where 5 million people might need food aid by early 2009. Unemployment was estimated above 90%. Gold output, once a major export earner, collapsed as mines shut. People did not sit around debating central bank credibility. They hunted for cooking oil, bus fare, and cash that would still buy bread by sunset. A currency collapse is not just numbers. It is a war on sequence. Breakfast becomes uncertain by lunch. A monthly budget becomes a comedy. The future shrinks to the next hour. Now ask the asset question again. What survived? Not the Zimbabwe dollar, not fixed wages, not pensions, not savings held in local money. What survived were foreign currencies, useful inventory, remittances from abroad, cross-border access, and in some cases claims on real commodities or businesses tied to external earnings. The BBC noted that the US dollar and the South African rand became de facto currencies, which means the public adopted them in practice even before the legal system fully caught up. In 2009, Zimbabwe abandoned its currency and adopted foreign money as the main means of exchange. The deeper lesson is almost primitive. When trust evaporates, people return to what they can touch, trade, or take across a border. Hard money, hard goods, hard relationships. In hyperinflation, a refrigerator full of food can be a better savings account than a bank. A cousin in Johannesburg can matter more than a pension office in Harare. Money does not disappear. It migrates. Like water finding cracks in stone, value moves toward containers that still hold shape. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you're still here, you're not most people. Hit subscribe. Because the next section is the part this channel was made for, the part they never put in textbooks. Now look at all three together. Germany in 1923, Argentina in 2001, Zimbabwe in 2008. Different countries, different decades, different political stories, same mechanism. In each case, ordinary people believed that a bank balance, a wage contract, or a state-backed unit of account gave them stability. In each case, the system reached a point where defending the promise honestly was more painful than breaking it. And once that point arrived, the rules were changed faster than the public could adapt. The same mechanism, different countries, different decades, same result. Local money failed as a store of value. Financial claims inside the failing system became traps. Value fled into what was real, external, or hard to rewrite. In Germany, debts evaporated in real terms, and hard assets outlasted paper marks. In Argentina, deposits were frozen, and dollar claims inside the banks were turned into something else, while dollars held outside and some real assets kept their power. In Zimbabwe, people stopped using the national currency in daily life and shifted to foreign money and goods. The pattern becomes impossible to ignore. Here is the deeper engine beneath the drama. When a state and its banks carry obligations, they cannot honor an honest money. They have only a few doors left. They can default openly. They can print. They can freeze. They can force conversion. They can haircut deposits, which means they can simply cut them down by decree. They can do some mix of all five. Each method looks different on television. But from the point of view of the saver, they often do the same thing. They turn a precise claim into a smaller reality. And notice something else. Money breakdowns do not always announce themselves with hyperinflation. Sometimes they arrive in clean shirts and legal language. Sometimes the notes in your pocket hold roughly steady, but access to bank deposits vanishes. Sometimes the unit survives, but your claim on that unit is rationed. The river changes course without ever looking like a flood. This is why people who focus only on prices miss half the story. The money can fail through value. It can also fail through access. Look at Cyprus in 2013. This was not Weimar. People were using euros. The streets of Nicosia did not fill with wheelbarrows of notes, yet money still broke for many depositors in a different way. Cypriot banks had taken huge hits on Greek government bonds. According to Yale's financial crisis case study, Bank of Cyprus lost 1.8 billion euros, and Lakey lost 2.3 billion euros on Greek bonds after the 2011 haircut. Banks closed on 18th March 2013 and did not reopen until 28th March. When they reopened, cash withdrawals were limited to 300 euros a day per person per bank. Transfers abroad were capped. Checks could not simply be cashed. Then came the bail-in. At Bank of Cyprus, 47.5% of uninsured deposits above 100,000 euros were converted into equity. Overnight, large depositors became involuntary shareholders. Think about what that means in human terms. Reuters told the story of Andrew Georgiou, a 56-year-old British-born Cypriot who moved to Cyprus with his father, carrying the family's savings for a fresh start. They had 750,000 euros in Lakey. Rumors spread. The bank manager persuaded the father not to move the money. 2 weeks later, Likey went under. Reuters reported Georgiou suffered a massive heart attack in June 2013 while his father was diagnosed with leukemia during the fight to recover their savings. Whether stress caused it cannot be proven. But the emotional truth is plain. A balance sheet event can enter the body like poison. Cyprus teaches a vital lesson. Even a strong external currency is not enough if the banking structure holding your claim is weak. The euro did not save uninsured deposits from being sacrificed. The currency survived. The claim did not. It is the difference between owning a life raft and owning a ticket that says a life raft exists somewhere nearby. Now bring Greece into the frame. In June 2015, Greek authorities shut banks to stop a run. According to the BBC and Yale's crisis case study, banks closed on 28th of June and reopened on 20th of July. ATM withdrawals were limited to 60 euros a day per card. Wages and pensions might still exist on paper, but daily life had to be squeezed through a plastic tube. 60 euros a day is enough to tell you whether your family will eat. It is not enough to make you feel that your savings are really under your control. A bank holiday sounds festive. In practice, it means the state has put your financial life in the freezer and told you to stay calm while the door seals. Then, Lebanon after 2019 pushed this pattern even further. Here the state did not announce one clean seizure. It produced a slow shredding. Banks imposed informal capital controls. Dollar depositors were often blocked from taking out real dollars, and instead could withdraw local currency at rates far below the market rate. Reuters reported in June 2021 that depositors withdrawing at 3,900 Lebanese pounds per dollar were doing so while the black market rate was around 13,000, a loss economic analyst Dan Azzi described as roughly 70% in value. The World Bank said Lebanon's crisis was likely to rank in the top 10, possibly the top 3, most severe globally since the mid-19th century. GDP fell from about $55 billion in 2018 to $33 billion in 2020. The currency lost more than 90% of its value. More than half the population fell below the poverty line. And the human consequences were not abstract. In 2022, Reuters reported that 28-year-old interior designer Sally Hafiz stormed a Beirut bank with a toy gun and took $13,000 from her family's frozen savings to help pay for her sister's cancer treatment. She became a folk hero because hundreds of thousands of depositors felt the same rage. In Lebanon, the line between bank robbery and self-rescue began to blur in the public mind. That is how far trust had collapsed. When citizens start cheering people for taking back their own deposits by force, the monetary system is no longer a system. It is an argument with armed guards. So who gets hurt most when money breaks? The historical record is painfully consistent. First, wage earners paid in local currency. Their income arrives last, and prices move first. They are like runners chasing a bus that keeps speeding up. Second, pensioners and anyone living on fixed income. Inflation is a regressive tax, which means it hits those with the least flexibility the hardest. The World Bank used exactly that language for Lebanon. Third, middle-class savers who followed the rules. They kept money in the bank. They held domestic bonds. They believed safe meant familiar. Fourth, small business owners with local costs and no pricing power. They must pay today and hope customers can still pay tomorrow. Look at the casualties across these cases. In Weimar Germany, clerks, teachers, and pensioners were devastated because their savings and salaries lagged behind prices. In Argentina, respectable depositors found their cash trapped and then transformed. In Cyprus, savers above the insurance threshold became part of the rescue package. In Greece, families with money in the bank still had to live under a €60 daily ration. In Lebanon, smaller depositors and workers paid in lira carried the heaviest burden while the well-connected often got money out early. History is not fair in these moments. It behaves more like a stampede. The people nearest the official exit signs are often the ones who get crushed. And who comes through relatively intact? Not always the richest. Often the earliest movers, people with foreign currency outside the weak banking system, people with access to remittances from abroad, people holding productive land, export businesses, inventory or goods that can be repriced quickly. People with debts fixed in local currency sometimes do unexpectedly well because inflation shrinks what they owe in real terms. Again, that is not a moral judgment. It is an autopsy finding. When the house burns, water, not good behavior, determines survival. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. The historical record shows that those who came through these periods largely shared three characteristics. First, they owned things that did not rely on the failing local promise. That could mean foreign currency, precious metal, export earnings, productive land, useful inventory, or a business with pricing power, the ability to raise prices fast enough to keep up. The common thread was not glamour. It was independence from the melting unit. Second, they were not trapped as pure creditors of the system. They were not sitting only in bank deposits, fixed pensions, long local bonds, or cash wages that moved too slowly. Some had debt rather than savings. Some had assets outside the banks. Some had legal or family ties across borders. They understood, or stumbled into understanding, that a claim inside a broken box is still inside the box. This sounds obvious after the fact. Before the fact, it sounds rude, pessimistic, even unpatriotic. That is why so few act in time. Third, they stayed flexible. Flexibility is an asset people underrate because it does not show up neatly on a statement. In Argentina, it meant distrusting the bank early. In Zimbabwe, it meant switching to dollars, rand, barter, cross-border shopping, or remittance networks. In Lebanon, it meant using family, diaspora links, and informal channels when formal finance stopped functioning. Flexibility is like a doorway cut into a wall. It looks unnecessary until smoke fills the room. Notice what I am not saying. I'm not saying there is one magic asset. History does not support that. Gold can preserve value, but it may be hard to spend. Property can survive, but not if you must sell into a panic. Stocks can help, but only if they represent real businesses with real pricing power or foreign earnings. Foreign currency can save purchasing power, but not if it sits inside a bank that can freeze access or convert it by law. The safest looking asset in one stage can become a trap in the next. Survival is less about owning a fashionable thing and more about understanding what layer of the system you are actually exposed to. That is the real lesson. When money breaks, the hierarchy flips. Convenience becomes risk. Liquidity can become illusion. A tidy statement can hide a political dependency. Meanwhile, something old-fashioned, boring, even clumsy, cash outside the system, tools, food inventory, a small export business, a paid-off piece of land, relatives abroad, can turn out to be the strong beam in the house. History is full of people who looked unsophisticated right up until the moment the experts were locked out of their own accounts. So return now to Buenos Aires, to that 34-year-old accountant on 1st December 2001. The screen flickers. The withdrawal limit is announced. Neighbors tell themselves it will pass. Some believe the state when it says deposits are safe. Some still think the numbers in the bank are the same as money. Carlos Panero does not know the full script yet, but he knows enough to distrust the stage. Years later, Reuters would report that he was among the lucky ones. He had kept dollars outside the banks. He held on. And when property prices in dollar terms fell sharply, he was able to buy an apartment. In the same country, in the same collapse, two people could both have savings and live through different realities. One owned a promise, the other owned an exit. That is why this subject matters. Not because history repeats in a neat costume. It does not. The flags change, the institutions change, the laws change, the apps get better. But the underlying fracture is old. When states and banks make more monetary promises than they can honor in real terms, someone absorbs the loss, sometimes through inflation, sometimes through default, sometimes through bank holidays, haircuts, forced conversions, or slow-motion devaluation. Usually through some mix. The names differ, the transfer is the same. And there is one more uncomfortable truth. The people most damaged are often the most responsible. The saver, the pensioner, the salaried worker, the small business owner who kept money in the bank, because that is what civilized life asks people to do. History shows that when money breaks, morality and outcome can drift far apart. The system does not reward virtue. It rewards distance from the point of rupture. So if you want the final answer in one line, here it is. The assets that survive when money breaks are usually the ones least dependent on the broken money itself. Claims on real things, claims outside the trapped system, claims that can move, reprice, feed, shelter, or cross borders. Everything else is more fragile than it looks. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.